Good afternoon. I would like to join Sarah in welcoming you to our conference here today. It's a testament to all of your commitment to crowdfunding that you're in here in this windowless basement ballroom instead of out enjoying the first day of real spring that we've had in DC. Although I think we're going straight over spring and into the 90-degree swamp weather. So I'm sorry, we did not, today's pretty. I'm not sure how the rest of the week is going to go, but thank you for being here in this ballroom with us today. I'm here to introduce our first panel, who, as Sarah mentioned, will help us understand what exactly we mean by fraud in the context of securities crowdfunding. Our moderator will be Sherwood Neiss, a principal of Crowdfund Capital Advisors. Mr. Neiss is known as one of the fathers of crowdfunding. As a serial entrepreneur and investor, he saw during the credit crunch following the recent crisis a need for change in the existing securities laws, and he decided to do something about it. As a co-founding member of Startup Exemption, Mr. Neiss co-authored the crowdfunding framework that was ultimately used in the Jobs Act that was signed into law by President Obama 1 year ago. Our panel members represent a variety of viewpoints in the securities crowdfunding regulatory environment. Joan MacLeod Heminway is the W.P. Toms Distinguished Professor of Law at the University of Tennessee College of Law. She's written extensively on the subject of securities crowdfunding. Before joining the University of Tennessee faculty, she spent 15 years in private practice, working in the areas of public offerings, private placements, mergers, acquisitions, dispositions, and restructurings. She has also served as an expert witness and consultant on corporate finance and federal and state securities law matters, and has written both teaching texts and articles in her area of expertise. David Blass is the Chief Counsel of the Securities and Exchange Commission's Division of Trading and Markets. Mr. Blass's office provides legal and policy advice to the Commission in establishing rules on matters affecting broker-dealers and the operation of securities markets. Mr. Blass has been integrally involved in developing recommendations for the Commission for its crowdfunding rulemaking. Rick Fleming is the Deputy General Counsel at the North American Securities Administrators Association, or NASAA. He has previously served as General Counsel to the Office of the Kansas State Securities Commissioner. For many years, he was a member of the NASA Federal Legislation Committee and served as chairman of the Coordinated Interpretations Project Group and as a member of the Privacy Project Group. Finally, we have Mercer Bullard, who is the founder and president of Fund Democracy, a nonprofit advocacy group for mutual fund shareholders. He is also a lecturer and associate professor of law at the University of Mississippi School of Law and a vice president with PlanCorp, LLC. He teaches in the area of securities and banking regulation, corporate finance, corporations, contracts, and law and economics. He has been named by Investment News as one of the 25 most powerful voices and one of the nation's top 20 influencers in the financial services industry. So, Woody, over to you. I think we're going to have a great discussion with this illustrious panel. I'm very excited.
Well, thank you. Hello, everyone. Thank you for coming. And Sarah and CrowdCheck, thank you for putting on this event. I think we can rest assured, hopefully, that with people like Sarah out there patrolling the marketplace, when this gets up and running, we're not going to have that much fraud out there, but we shall see. I'm excited to talk about this subject, partially because I'm coming at it from the point of view of an entrepreneur. I'm a very optimistic person. I've started a business. We were able to raise capital in the private capital markets. And I've approached it from the point of view of, yes, we can do this. Yes, we can be transparent. And I had the opportunity to be on a Bloomberg interview on Friday with Mercer at the end, and Mercer brought up a very good point. We're not really worried about people like me that are going out there raising capital because we're probably going to be the ones that are following the rules. It's the other people that are smart, that are looking for opportunities to take advantage of people, and those are the ones that we need to be concerned about. And so that's why I think having conversations like this are critically important. Because we need to have an efficient, a robust, a transparent marketplace or this whole thing will collapse. And I think that's one thing that we will all agree on is the need for transparency in this marketplace. Fraud is something that does exist. It's a part of our daily lives, but it's not something that we want to overtake our lives either. So I think with that, what I'd like to open up with a general discussion about what is fraud and what is the legal definition of fraud. And so with that, I'd like Joan to step in.
Thanks, Woody. Whoa, got a moving microphone here. Sarah asked me to say a few words that really follow, I think, nicely on her introduction before I get to the what is fraud question, so I'll take the liberty of doing that. First, I think it's important to distinguish between the types of crowdfunding that Sarah alluded to in her introduction. we all know, I think, that crowdfunding, of course, is some bizarre cross between, you might not find it bizarre, Woody, but between social media and traditional corporate finance, using the internet to get financial capital from the crowd, a large, diverse, publicly available group of investors. And of course, and this is where I think we draw the distinction here that's really important, when we use the internet to get capital from the crowd, and we do it by offering and selling what are deemed to be securities under federal and state law, then it's securities crowdfunding or crowdfund investing. So we're talking about the difference between a Kickstarter that has a website that offers folks maybe products or accepts donations, and the difference between that and actually raising money by selling profit-sharing interests or revenue-sharing interests in something. And that's where the rubber really hits the road here for purposes of our discussion of fraud. Recognize in the background that this type of finance gives free access to an amorphous, potentially unsophisticated, non-accredited investor crowd that includes funders that don't have significant knowledge maybe about corporate finance, capital raising, or even the business or project that's raising the funds. They may not even have access, given their position, to the level of information necessary for them to be able to understand the potential risks and rewards of funding a particular business or a project. And maybe, in fact, they'll have knowledge of none of that. They also may not have a sufficient amount of current and saved money capital to bear a significant risk of loss. These are all historically the things that we've looked at to help protect people in this area. The Securities and Exchange Commission obviously has to enact regulation to legalize crowdfund investing under the Crowdfund Act, which is Title III of the Jobs Act. And under that law, we're going to have to conduct those offerings through registered brokers or through a new form of registered intermediary denominated a funding portal. So these securities transaction intermediaries are going to be regulated by FINRA. So I want to clarify here first, before heading into the fraud question, that crowdfunding and crowdfund investing are different from other types of offering that may be done on the internet. It's important to remember that not all internet-based offers and sales of securities are crowdfunding. Public offerings can be conducted through the internet that are registered with the Securities and Exchange Commission, and under forthcoming SEC rules that are mandated under Title II of the Jobs Act, Rule 506 private placement offerings under Reg D are going to be able to employ general solicitation and advertising, including through the internet, as long as those sales under those offerings are made only to accredited investors. But neither of those two forms of internet offering are actually crowdfunding or crowdfund investing. And yet you will find on the web lots of references to, for example, accredited crowdfunding. I think we have to be very careful when talking about fraud and other risks of these ventures to separate those things out. Crowdfunding merely to harvest investors, for example, for Reg D offerings is something that I know a lot of us are concerned about. We need to talk about that today, either here on the panels or in the cocktail hour afterward. So now, ending on a high note, because I said I would finish in 5 minutes, fraud in crowdfund investing. There are obviously many liability provisions under our two principal federal securities laws. The Securities Act of 1933 is amended, and the Securities Exchange Act of 1934 is amended. And I dare say we'll talk about a lot of them today. But I want to, as an introductory point, focus us on the omnipresent specter of fraud in crowdfund investing, as Woody acknowledged, that specifically relates to Section 10B and Rule 10b-5 under the, in and under the 1934 Act. There are only 3 core elements to fraud. Now, there obviously are other ones that are added on by private actions, but 3 core elements. They are manipulation or deception, including by way of something as simple as the misstatement of a material fact or a misleading omission to state a material fact. Scienter, which is that state of mind that Sarah referenced that involves intentionality or reckless disregard of the foreseeable consequences of your acts. And then last but not least, all of that has to be in connection with the purchase or sale of a security, hence the differentiating between crowdfund investing or crowdfunding securities and other types of crowdfunding. That connection does not have to be very direct for these purposes. Okay, so important, I think, for issuers, for intermediaries, including those brokers and funding portals who have disclosure obligations under the Crowdfund Act, and anyone else who makes voluntary disclosures in connection with a crowdfunded offering of securities. if they are making misstatements of material fact or omitting to state material facts necessary to make what has been stated not misleading. So there's a lot more to this. I'm hoping that we can talk about this and other liability threats under the Act. I'm going to leave that to our ongoing discussion, which I look forward to.
Great. I mean, one of the things that I'd like to point out within this statute so that everybody understands the investor protections that were built into it are the limits that and the structure that takes place. So, for instance, there's background checks that have been mandated, and that's where CrowdCheck comes in. We've got disclosures that are mandated, a business plan, evaluation of use of proceeds. You've got a one-year holding period on these securities, and we're hoping that type of holding period prevents pumping and dumping of securities. All of this needs to take place on SEC-registered portals. So we've got a funnel that's taking place where all of these transactions are taking place. There's caps on how much issuers can go out and raise. So we put limits out there, and then we force them to hit 100% of their funding target in what we call all-or-nothing financing, or no money's exchanged. All the money needs to sit in an escrow account, and until 100% of that target is reached, it doesn't go into the hands of the issuer. We also put caps on it for investors. Depending on net income or net worth, you can only invest up a certain amount of money. Investors are also going to have to take an education component because, as Sarah was pointing out in the beginning, this is new for a lot of people. People might be investing in public stocks, but they don't necessarily understand all the components of investing in private shares, and that's why education's component is very important. And we also have a window in the legislation that allows people to actually change their mind once they funded it prior to closing, and they can actually back out. So we've thought really clearly, and we tried to bake in as much investor protection as possible. So with that, I really would like to open it up to Rick or whomever would like to jump in on this, David, and say, we've tried to think of how we can protect investors, and we've tried to look at ways in which we can disclose as much information as possible. You guys have the experience of seeing fraud take place in the marketplace around us. So you've seen the legislation, you've seen the limits that we put in there, but in your minds, you probably also know or have an idea of what fraud is going to look like in this. Could you tell us examples of what you think are going to happen?
Sure, and first let me thank you for inviting me to be on this panel. It's a good opportunity for NASAA's voice to be heard on this issue. Just a little bit about my background that I think might be important for this discussion. Sarah mentioned that I was with the Kansas Securities Commissioner's Office, and in Kansas, the staff attorneys actually prosecute securities fraud cases. So I have personally handled a number of securities fraud cases, and there are wide varieties of frauds out there. I will say that most of our cases involved unregistered people that were basically just trying to steal money. But I have actually sent to prison at least one stockbroker I can think of and one investment advisor. So to think, and these are people that are licensed professionals that work in a very highly regulated industry and have a lot of rules that they have to follow. And they still find ways to commit fraud. And I think it's important to realize that there, even though there are registered portals involved in this, and I think that's a vast improvement over the initial crowdfunding proposal that came out because it gives some adult supervision to this industry. I think it's probably naive to think that there's not going to be fraud occurring even amongst the registered population. And of course, we also have the concern with the people that are going to be out there just stealing money without even trying to comply with the exemption or with the registration process. So I don't know that that answers your question, but it kind of gives you a little bit of our concern. We see cases already involving highly regulated entities that are subject to a lot of scrutiny and a lot of rules, and they find ways to violate those. So I don't know exactly how it's going to happen, but I predict that it will.
Okay.
The other thing that just from the state's perspective, another thing about me is that I grew up in a very small town. I graduated with a class of 15 other students in my class, and that was a public school. And so when I think of crowdfunding, I'm expecting a few months from now my old classmates to start getting solicitations over Facebook or some other method to invest $1,000 in some business. And I'm sure some of them will, and there's nothing wrong with that. But when something bad happens, and a person like that in a small town out in Kansas somewhere has a problem, they're not going to pick up the phone and call the United States Securities and Exchange Commission. They're going to be much more comfortable talking to somebody in state government. And likewise, the small business person in Leroy, Kansas, who happens to be Luther's Smokehouse. They make really great beef jerky, by the way. But when they need to, raise $500,000 to buy equipment to expand, and somebody comes along and says, you really need to do this crowdfunding thing, and they want to check out this company that's talking to them about doing this crowdfunding offering, and they maybe want to talk to people about, is this really a good idea? Are there better alternatives out there for me to raise this money? They're not going to call the SEC. They're going to call the people in the states. And so I think one thing that you need to realize is you've probably heard that the states have been preempted from regulating in crowdfunding. But that's not the case. The states are not going to be on the sidelines because the way this has been set up, the federal government makes the rules, but it's going to fall to the state governments primarily to enforce those rules. Now, I don't mean to minimize the work that the SEC and especially FINRA will be doing in this area, but when there are problems and there are frauds, it's going to be the states that are handling it because really, is the federal government going to spend a lot of time dealing with a $1,000 loss in one of these deals?
Well, so Rick, how do you feel about on crowdfunding platforms where the communication is many to many and the diligence and the crowd wisdom that takes place and allows people to decide whether or not they want to back a company takes place really in an open dialogue. So going to that all or nothing financing and then leveraging the power of the crowd. And I understand that there's herd mentality and that's not always good because people just go where the crowd's going. But the difference between, I think, what was taking place prior to this and what the beauty about crowdfunding is, instead of one-to-one interaction where someone can say, buy my beef jerky, and you have the opportunity to invest in it, now you actually have to put that beef jerky company on a platform and then invite people through, social media to that pitch page, and then they have an opportunity to decide whether or not it's worthy of funding. So the difference between the old mechanism and the new mechanism, one-to-one, many-to-many communication, do you think that can help, or you think that's going to hinder, or you don't think it'll have any bearing on?
I think it does help, but I don't think it's necessarily the end-all and be-all, the wisdom of the crowd. I think it's especially good. I get back to this idea of having a funding portal involved. Without that, I think this would be a total disaster. But even with a funding portal in the mix, we see cases even over the internet. Just last month, a number of cases, or a number of states took action against a company called Profitable Sunrise. Tony Miles, I think, is in the room. He's the DC regulator. I think he even did something with them. But the basic idea of Profitable Sunrise was that every sunrise, every morning, your money would grow 2%. And it was just a standard old high-yield investment program that's run from overseas, the Czech Republic, I believe this one was. Just, standard stuff. If you get on the internet and you do any kind of Google search about the promoters that were involved or even the name of the company, you would have discovered that this was a Ponzi scheme. But you go to their Facebook page and they have almost 5,000 likes. And all the comments on their Facebook page talk about how wonderful this company is because this is God's way of providing income for people so that they can go out and build the kingdom of God. Typical affinity fraud kind of stuff. So just the fact that something's on the internet or people have the ability to go out and find information about a company or an investment offering doesn't necessarily mean that that wisdom of the crowd is going to translate to the people that are being solicited for the investment.
I agree. I mean, I think one of the, actually, Mercer, you want to jump in?
Yeah, I know our time is short. I don't like to beat around the bush, and most of you know that. The question is really, what difference is crowdfunding going to make? Right? There are fraudsters out on the internet, so why are they going to be helped by crowdfunding? The vehicle is actually going to be one that's related to Reg D filings, and this is the reason. Reg D is now going to allow for general solicitations. What that means is that a state regulator like Rick is not going to be able to look at a communication that is out there, let's say, on an internet billboard and take action. There will not be any pre-filing. There will not be any way to do a check until that person's already sucked in a few $1 million over the internet and is gone. Now, if you couple that with crowdfunding, you can use that front to do more fundraising, so to speak, through crowdfunding. So putting on my ripping off investors hat, that's the way I would do it, and that's the way in which crowdfunding actually facilitates it. A lot of the criticism about internet fraud already being out there, that's completely valid, and it's on us to say, what difference does crowdfunding make? If the SEC requires substantial pre-filing with respect to 506 offerings, that is actually going to go a long way to mitigating the potential for fraudsters to take advantage of crowdfunding to get through that window. Or if the SEC takes the position that those will be integrated with Reg D offerings, and therefore states can, as they're sitting in their offices, immediately pick up on communications and go after them. Otherwise, they're going to have to show that the communication was inherently fraudulent. If they have to do that, they will not get the fraudster until it's too late.
But don't you think that the beauty about crowdfunding, and again, I'm jaded, because I just see the optimist side of it, is the digital footprint of everything that's going to be taking place. So the business plan, the use of
30 trillion
proceeds.
websites. 30 trillion, right? You heard Bloomberg TV. There is no footprint. These people don't care about a footprint. They just do this until they go to prison, if you want to call it prison, where they've got large television screens to watch all day with Bernie Madoff. But the problem here is that they are already going to do the fraud. This isn't caused by crowdfunding. And the crowdfunding space isn't really going to be a securities fraud space either. That is going to be the $100,000 to $500,000 offerings where people are doing what the law really treats as mismanagement, not securities fraud. Most of those cases are mismanagement cases. You're going to see a lot of them. And in the long term, the best protection against that is going to be what's called diversification. But ultimately, what you're going to see in terms of fraud is going to be people exploiting what's specific to crowdfunding and the greater ease of access that the internet provides, along with the loosening of Reg D offerings with no pre-filing. So that pre-filing is an important piece.
I just want to jump in really quickly here before you jump in, and this relates to your stuff too. I think one of the things that we don't think about when we think about crowdfunding in its purest sense is that there are going to be a lot of internet things that look like crowdfunding to people that are not. So there's going to be confusion, I think, in the marketplace, and that's one thing that that we have to be careful of. And maybe securities fraud isn't the answer there. Maybe it doesn't even end up on a state regulator's desk in the securities division. It ends up in a general fraud area because it's actually not relating to securities at all. But unsophisticated people in the internet crowd are not going to be able to, unlike a lot of us in the room, make those distinctions.
So I don't disagree with anything really that's been said so far. Just sitting between two law professors, how can I disagree with a statement about what is fraud? My goodness. I would say, you know, thinking about this from my perspective, which is my role in the crowdfunding arena is to try to write the rules to make crowdfunding work. Congress made the decision for us in the Jobs Act to allow crowdfunding to blossom as an investment method. And my rule is to write rules that make crowdfunding as an industry work, all the while balancing the need to prevent or root out fraud. I should say, by the way, as we're always required to say at the SEC, my comments are mine and mine alone and not anybody else's. So, you know, when we think about the rulemaking, and I'll bleed a little bit into the subject matter of the second panel, when we think about the rulemaking, one thing we think about, Rick hit on it, is the role of the intermediary in the space. So unlike some other thoughts about what crowdfunding could look like, here you have a regulated entity that's both SEC and FINRA registered, for lack of a better term. And so you have two, at the federal level, you have two regulatory bodies looking at all of the professionals that are in the space. Funding portals are one type of intermediary, broker-dealers are another, and broker-dealers can do in the space what they do today in the brokerage world. But funding portals are really unique and a novel concept for us under the securities laws. They're basically a limited purpose broker. They can't provide any investment advice to investors. They can never come into possession with funds or securities, so their ability to influence investors is somewhat limited, or their ability to abscond with funds and securities is severely limited if they do it the right way. However, they do have a significant role in dealing with the issuer. So I think, Rick, I think you were the one who raised it earlier, one could imagine issuers, small businesses, being pitched on the idea of crowdfunding. Well, is that really a good model for that particular issuer? We'd be interested in knowing how funding portals go about advising issuers on whether crowdfunding is right for them. After all, for some companies that may have a venture capital fund or some other exit strategy or life of the company, crowdfunding may or may not be right for that type of a company that wants to go through that life cycle. They also have, I think, are going to have a very significant role in helping the issuers craft their disclosure. Now, I think that's probably a good thing where you have very unsophisticated issuers potentially in this space and unsophisticated investors. Somebody who kind of knows what they're talking about has to get involved on a day-to-day basis. So it can be very good for funding portals to be in that role. On the other hand, if the funding portals are really integral to the disclosure that an issuer is giving, that funding portal, it's very important that the funding portal do it right. And so we'll be looking after our rules are in place, certainly, of the role that funding portals have in crafting disclosure with issuers and being sure that the funding portal did their job in the right way. And of course, fraud can take on a lot of forms and varieties. Certainly, two we've heard about are material disclosure issues. Certainly, absconding with funds and securities is a severe problem and mitigated in some ways in the crowdfunding space because of how funding portals are going to be operating. However, I do think there's a federal oversight, there's a FINRA oversight, and I think it should be complementary with the states in combating fraud. I fully support Rick and his efforts at looking at the crowdfunding space. And so I think there's a multiple layers of oversight, and at least over the professional entity that's involved in this space. So I would like to say finally, call the SEC if you see fraud. We are happy to hear from you. Call your state regulator, but also call the SEC. And
call either one, we'll try to talk to each other.
Exactly. But then the final point I want to make is, fraud can happen in many, many circumstances. It can happen in a registered offering. It can happen in an unregistered offering. There are plenty of private placements going on today. Frankly, if somebody wants to do something bad, they can set up a crowdfunding site today and try to defraud people. We at the SEC are actively monitoring players who do that. Believe it or not, we spend a lot of time, even though crowdfunding's not up and running and legal yet, we spend a lot of time trolling the websites for people who are illegally engaging in crowdfunding. It takes a long time for things like that to work through the SEC, but that's something that's at the top of our radar, and certainly we're working very collaboratively with FINRA, our partner regulators, in trying to root out fraud. So that's my...
Okay, great. I want to switch over to material misstatements. But before we do that, Sarah did just hand me a piece of paper saying Mary Jo White was confirmed by unanimous consent.
So I really mean it when I say I don't speak for anybody at the SEC.
So, David, I really look forward to you getting back to the office and getting these proposed rules on her plate. Just saying. So being an entrepreneur, having gone out and done 3 Reg D offerings, having told my investors what I plan on doing with that money, when I got into it, I realized, you know what, it's not quite the way that I thought it was going to be. I need to pivot. I need to make a change. Now, I was transparent and I had conversations with my investors all along, and they knew what I was doing. How much fear and anxiety is there in your heads over the pivots, over the misstatements that might be taking place? And does it come down to entrepreneurs or issuers need to be transparent and diligent in communicating with their investors?
So I'll start that, and if others want to weigh in. Frankly, the greatest fear or concern I have is a little bit different, which is not so much the pivot, it's the pivot from the offering to life as a crowdfunded issuer. How does the issuer keep track of 1,000, potentially 1,000 or more investors? How do those investors keep track of their investments after the crowdfunding issuance is done? What mechanism are the funding portals, the broker-dealers, the issuers going to come up with to allow tracking of those investments? To me, that's a very complicated question, and it's not one that I've fully gotten my mind wrapped around how exactly that's going to work. It's a little bit different than the issue you're bringing up, which is there's been a well-disclosed business plan that ultimately didn't work, I take it, and there's a need to change that plan, and I think that comes back to disclosure. That's something that funding portals and brokers need to work through with issuers to contemplate the need for changed business plans, and then certainly to update investors to the extent that business plans need to change. Frankly, you know, put yourself in the investor's shoes. Look, a lot of these types of issuers, they're very small issuers. A lot of them are risky as issuers, as investments. And they're entering into potentially risky business areas that may or may not pan out, and so there can be some flexibility for change. But if you're an investor, you want to know that going in. So the best answer is build in some disclosure about what potential changes might occur over time. Do you guys have a perspective?
Yeah, I'll just add a few things that I'm sure Mercer and others will have something to add to this as well. But under Section 10B and Rule 10b-5, there are lots of different ways that you can handle this. I mean, one is the defense against materiality that you basically are going to put either under the Private Securities Litigation Reform Act, your well-tailored disclosures of things that could change and update them as time goes on. You can do the same thing under common law. And so there are defenses, you know, that are built for this exact kind of issue, the pivot. So you have to get that disclosure in up front, though, right, to be able to take advantage of those common law and statutory doctrines so that you can make sure you have a defense. But even absent defense, if you're thinking about materiality, you have to think about, I mean, is the pivot the entire business plan, right? I mean, is it a little piece of the business plan? You know, what is it? If it's the entire business plan, there's that business probably was not ready for an offering in the first place. I'll just sort of submit that. But if it's, you know, if it's 6 months later or a year later, I mean, what's our time horizon that we're talking about here? Is the pivot after 2 years? Is it because you couldn't get enough financing to execute on the first business plan and you said you were only seeking money for a year or a year and a half? What's the nature of the security involved, too? So I've written a bunch about using investment contracts in addition to equity-based crowdfunding, and of course there's debt investing that also can be done through crowdfunding. You know, what promises did you make inherent in those instruments, and how does your change in business plan interact with those? There are lots of different, I think, component pieces to this. It's not wrong to change your business plan. The question is, what have you told investors? What do they expect? And how have you couched that for purposes of those investors that you're seeking?
So in investment documents, if issuers disclose that there could be pivots along the way, you think that is a form of...
That's probably too generic, but unpack that.
Okay.
Right, and give reasons why pivots could take place, and you start getting, you know, into possible defenses against securities fraud actions.
Yeah, we would probably look at the reasons for the pivot, too. If you told your investors that you had a supplier lined up, for example, but you failed to mention that there were possible hitches in the supply line, and that became a problem and caused you to do the pivot, then that would be probably actionable, some sort of misrepresentation or omission in connection with the sale. You know, other examples I can think of, you know, you may say something about your customer base and how much demand there is for your product, or how you've developed this great new device or something like that, but you're not really quite as far along as you made it seem to your investors. That's, you know, getting back to you mentioned that as an entrepreneur, you're optimistic by nature, and that's true. And of all entrepreneurs, I think, and that's a good thing. But when you translate from the world of sales to the world of selling securities, you really got to be careful because you have to be very cautious in the statements that you make to investors to encourage them to invest in your business. It's very different than encouraging them to buy your product.
I guess I have a very different take on this. The bulk of cases are not based on changes in management and changes in the way the business is going. The cases are brought because of related party transactions. Because Uncle Joe is getting paid, he's on the payroll, he's not doing anything. That's what's going to happen here. There are going to be cases where there's massive dilution. You issue shares, you get $500,000, you issue more shares to yourself. I mean, if you look at the disclosures, those are also going to be the cases you'll be able to make on the basis of what's really a registration statement. It's not going to be pivoting, and pivoting doesn't really count anyway because it's the truth of the statements when you made them that really matters in the cases, not what happens later. So I think that's just a red herring. The cases are going to be, especially for the regulators, where the person running the business is trying to separate investors from their money. That's going to be plenty to keep them busy. And they are not going to they're not going to worry 1 second about whether somebody's business plan changed and whether it was really fair to do that with investors' money. Those cases just are not brought. Another point I want to make is, 10b-5 gets a lot of attention. People don't bring 10b-5 cases anymore if they want to succeed in this space. You can't win them. They require, as Joan said, scienter, intent. You can't prove intent. They require loss causation, which means you have to show the actual fraud caused the loss. You can't prove loss causation. You're not going to win these cases on basis of fraud. Where you're going to get sued is going to be 12A2, which is prospectus liability for misrepresentations that requires no scienter. Now, you're still going to have to show loss causation, which is one of the reasons why these background checks are not going to matter at all for personal liability purposes, because background checks don't relate to anything that is going to be shown to be loss causation. That is, the guy lied about his resume or something, and that's what causes security to go down in value. So the cases are going to be misrepresentation cases where you can show that what was misrepresented actually cost you your shirt, or it's going to be basically self-dealing using capital structure and related party transactions. If I were looking in the space of the non-fraudsters, or rather the issuers, those are the things I'm going to look for, especially since there's an incredible amount of detail that is required for you crowdfunders to put in your registration statement about exactly those things. What the crowdfunder advocates did is they created a statute that in some respects requires more disclosure, more damning disclosure, than you are required to provide in an IPO when you're going public and raising $1 billion. That's what you all chose for your disclosure and your registration statement. And if I were a plaintiff's lawyer and I work on a lot of these cases, you basically put a big target on your foreheads, and that's what I'm going to aim for. It's not going to be some change in business or some pivot in business strategy.
So I'm going to agree with you with respect to private actions, but I think we're ignoring the whole possibility of, and it goes through waves and ebbs and flows, and we now have a new enforcement-oriented chair of the SEC, public enforcement, and to the extent that things are really, really bad, the DA's office jumping in. Now, you may disagree with me, but there certainly are some prospects there, not only under Section 10b and Rule 10b-5, where only those three core elements, and yeah, you're right, scienter is hard to prove, but I'm shocked sometimes at what you can find lurking in the background of the internet and on Facebook that's being used as evidence these days. And these are, after all, internet-driven businesses, so there could be some very interesting things out there, but also just thinking about pure violations of Section 5. Where there actually has been a botched crowdfunding. It doesn't meet the requirements of Section 4.6 as articulated and as played out in the SEC rules, and we don't know what they are yet, but it's quite possible people could put their foot in it. So, and that's not fraud, I recognize. That's a different kind of threat. But if I were, and I don't know because we haven't seen the rules yet, but if I were advising someone and took a look at the rules, I would say in the background that there are some interesting perils here that you would have to include in your business model as potential risks. You might say the private litigation in the fraud area under Section 10b and Rule 10b-5 is going to be a minimally discounted, piece of that. On the other hand, if you have the same issuer doing multiple offerings, if you have the same funding portal, and they're going to do multiple offerings, if there's an aggregation principle in here where the same type of error is being made over and over again, I think that is a significant risk of business, and I think those people who are advising folks to set up their businesses have to take those kinds of things into account and not discount any particular threat of liability under the 33 or the 34 Act.
So I want to sort of flip it around here, and you were heading that direction. You all come to the table with the point of view of what has gone wrong and what can go wrong. Assume an entrepreneur comes up to you. They want to crowdfund. You have to be open to this idea, okay? You know what mistakes can be made. What are the things that you're going to tell them that they need to do? What are the disclosures that you're going to say that they need to be careful about? Where do you think they need to get started to make sure that they don't get claimed for fraud?
How much money do they want?
Yeah, right.
Well, the statute only allows you to raise up to $1 million a year.
How much money is this person? I mean, if he wants $500,000, I tell him to go to Reg A. There's your answer.
And what?
Or definitely not crowdfunding. Reg A or private offering, not crowdfunding.
Because of?
Too many burdens. It's a registration statement, too much liability. It's going to be too costly. It's just not going to work. You got audited financials. You might as well do something where, as you're paying for the audited financials, you go whole hog and you got a lot more flexibility. You can keep coming back and raise up to $50 million. It's just not going to be a place where people who want $500,000 plus are going to go if they get good advice from lawyers.
So Reg A plus, just to qualify, you can go from saying raising up to $50 million.
Up to 50.
Okay.
or 504. I mean, there's just a lot of ways to go. Now, the SEC, the statute did a savvy thing by giving the SEC authority to raise the $500,000 plus limit. Is the SEC going to do that?
I don't know. We'll find out from our new chairman.
It was worth a try.
The timing makes it very easy for me.
Well, there's going to be a fight over that, so look for it. I'm sure.
David or Rick, do you have any guidance for any would-be entrepreneurs that are looking to crowdfund?
I think just getting back to what I said before, just be very cautious in what you say to investors. Don't oversell. Don't over-tout. It'll come back and bite you. That's the biggest thing.
Yeah, I mean, I think, look, the issuer is going to be working with a funding portal, a broker-dealer. They're going to have to be able to do this. I think the real challenge is use of social media. So they may be able to get their disclosure in order and do a crowdfunding, but they're going to want to do social media. They're going to want to talk to people. And they have to be very careful with what they do there. As you know, the Act allows crowdfunding issuers to refer to the portal, right, that has the disclosure. But naturally, people in this area, especially in the technology field who have used crowdfunding in the past, want to make something out of social media. And that's going to be a real challenge for them not to wander into difficult, troubling territory for them.
And we're not, I mean, I think this is implicit in what everybody's saying, but this is not a new thing, right? I mean, we have a due diligence defense under Section 11. We have something that's pretty close to a due diligence defense under Section 12A2 that Mercer was alluding to before. There have been models for how you back up disclosure, how you know what to say, that are tried and true that have been used, and you use them for Reg A offering circulars as well. I mean, most lawyers know how to do it. A lot of accountants and consultants know how to do it. There are lots of experts out there, including a lot of you sitting in the room, that know exactly how to do this, including CrowdCheck, Sarah said. So, I didn't know I was here to give a plug. But yeah, I mean, that's why we're all here, right? Is we care about those kinds of things. And due diligence is going to be important. I mean, I think by adding the funding portals in, we all of a sudden now have this new we're going to have to look at due diligence for them because they have different statutory responsibilities than the issuers have. And the issuers have new statutory responsibilities that don't exist in the Section 11 and Section 12A2 spaces. We've known it. Disclosures, new types of mandatory disclosure that have to be made. That but we can create checklists. We're lawyers, right? That's what we do.
Yeah. Another piece of advice would be, I'd say, go to a portal that has a very well-developed standard set of papers, and you just do what they tell you, and make sure that they've been vetted by a securities law firm with a lot of insurance, and make sure that you don't let capital structure issues get in the way of raising your money, because your best protection is going to be use something that's been standardized and vetted, and it kind of goes off of what Joan was saying about how to avoid liability. And then David made a great point about, you can barely get sophisticated CEOs to keep their mouths shut during IPOs. How are you going to keep somebody who's already on Facebook from bragging about their offering? Well, they're not going to be allowed to. All they're allowed to do is say, probably, I'm making an offering, here's my portal. Good luck with that.
All right, so with that, let's see if people have questions in the audience. I see Doug Elenoff, you have one, please.
Thank you, and thanks everybody for being here. Terrific discourse, really. I guess as I see the markets emerge, crowdfunding, Title II and III are not permissible. Markets are interesting phenomena, and new places to do business so about doing business. So we see the accredited platforms doing business, and we see in different states are changing their securities laws to allow crowdfunding effectively for their general solicitation of a certain amount of money to non-accredited investors. And is there anything in the data of those deals, which are apparently hundreds in California, to suggest that there's actually going to be fraud at a statistical level any different than what you're experiencing in your other regulatory practices? If you're aware.
Yeah, I'll start. I can't say that I'm sufficiently aware of any statistical evidence based on what's occurred to date, although I guess those must be fairly narrow offerings purely within a state if there is an equity or some kind of a securities-oriented crowdfunding going on, because that's really not permitted until it's purely intrastate over the website.
No, it's not through a funding.
Okay, all right.
It would mitigate the fraud.
Okay, I call my California colleagues and find out what was going on.
Prosper.com has been doing crowdfunding for years. No one pays attention to it when it's death. So lots of data on fraudster.com, and people actually developing a diversified portfolio and getting economic risk-adjusted returns.
So the short answer is I don't know of any statistical information from that. That points one way or the other.
If people could line up at the mic, and while you're doing that, I know we did a bunch of research on fraud in the space, and crowdfunding's been happening, just so people know, globally in the UK and Australia for up to 5 years. There's been 0 instances of fraud taking place. As a matter of fact, in Australia, with the Australian Small Stock Offering Board, it's worked so well that the survival rate of companies that have been crowdfunded is 86%. And in the US, you see that there's 50% failure of companies after 3 years. So no one's done the deep dig to see if there's a correlation between the two, but I would have to say that there's something going on there.
I think we have to be, excuse me for a minute, I'm just going to take panelists' prerogative. I think we have to be very careful about talking about zero fraud in other countries that have very different fraud rules than we do, very different cultures than we do. There's a lot of academic literature out there that distinguishes, in fraud and non-fraud areas. And really, even here in the United States, the difference between the debt market, the equity market, and an investment contract market at different levels of activity are hugely different. So not to disagree with the data, just to put a cautionary note on it.
And that's only within the crowdfunding space out there. Yes?
Yes,
The information out there, there's 2 industry associations that you can look at. There's the Crowdfunding Professional Association, and to Mercer's point earlier, in terms of standardized documentation, there's a group called Crowdfund Intermediary Regulatory Advocates. And this is a coalition of future competitors that are sitting down at the table and trying to come up with best practices, standards, formats, documents that can be good for the crowdfunding industry. So.
And I think you were also asking about accounting and the way that it interfaces in.
Yes.
Yeah, in Title III, if you have an offering of over $500,000, you have to have audited financial statements for that. So that involves a very high level of financial activity, but the types of disclosures that issuers are going to have to make are going to involve at least accountants in the background. The SEC obviously has a very rich accounting and regulation set of rules that are employed in public company disclosures. Until we see the SEC rules, I don't know that we will know exactly what pieces of that might get pointed to in order to make financial disclosures. But there will be more accounting, in particular, at the company level, more activity for accountants. I just don't think we know what that is yet.
Well, we know that for 100,000 to 500,000, you have to get an independent public accountant to sign off.
Right.
And for 100 and below, you've got to submit your tax returns, and the CEO has to certify the financials himself.
and what about the FASA, Financial Accounting Standard Board? They don't have nothing crowdfunding, do they?
The audited financials will be subject to basic financial standards. The SEC is going to get to make the rules for the 100,000 to 500,000 standards, and maybe they can give us some insight as to how those will go.
He's much more blunt than I am. I was just going to leave it to David to say something.
I don't know how they're going to go. I do want to say, nobody's asked about timing. There have been a few allusions to timing, and I know people are really disappointed that the rules aren't already out and live. Rest assured that the staff are working extremely hard to get the rules, first of all, to get the rules done and to get them done right. With Manager White's, I guess I should say Chairman White's announcement today, certainly we've been in a little bit of a period of flux at the SEC over the past some time. She, at her hearing, said that this, among many other things, to be frank, at her confirmation hearing, would be priorities for her. So we're hoping to be able to move forward on a good time frame on the rules. To the extent that there are questions about what those rules precisely will look like, it really is difficult for somebody like me to really comment on that, because I don't know what her views are at all on any of this, and until we have that kind of a dynamic and discussion with her and with the other commissioners, which we have with the other commissioners, but until we've had that kind of a discussion, it's hard to predict where she and the others will end up.
Hi, I'm Ken Hoover. I'm a reporter with American City Business Journals. You just started talking about the question I was going to ask you. You said in a good time frame, can you be a little more specific as to when you think the rules might come out, and then once the rules are out and you get comment, what's your projection for when equity crowdfunding actually would be up and running?
Well, I can talk about the process. Predicting timing is very difficult. For a year, I predicted that we'd come out with a release requesting information about a fiduciary duty for investment advisors and broker-dealers. That took a year of me talking about that. At some point, you want to stop talking about it. It never happens, but that did happen eventually. In terms of this particular rulemaking, it really depends on the chairman's priority. And in terms of process, where we are right now at the SEC is in a need to publish a rule proposal that would set out for public view and comment what we think the right set of rules should look like. We'll take our best shot. We've had a lot of dialogue, frankly, with the industry, a lot of dialogue with the industry. A lot of letters have already come in informing us of what various interested parties think the rules should look like. So we've gotten a lot of input in, which has been tremendously valuable in this space. But because I can tell you, I'm not a crowdfunding person predating Jobs Act. I had a lot of learning to do, and my colleagues and I all have learned from the process. And I think what you'll end up with is probably a better product in terms of rule proposal than if we had jumped out of the gate immediately with a rule proposal. We publish a rule proposal. At the SEC, then we get comments in. There'll be some period of time for you all to weigh in and tell us what you think about what we came up with. You'll give us comments. It'll take a little while for us to digest those comments together at the staff and together with our commissioners. And then we'll make a recommendation to our commission for a final rule. And then hopefully, unless we've gotten it horribly wrong at the proposal phase, we'll have an adopted rule. That's one part of this process. But the crowdfunding is a little bit unique because we have parallel paths running, and that's with FINRA as well. So as you know, funding portals must become members of FINRA before they can start offering crowdfunding, unlike, well, broker-dealers as well have to be FINRA members. FINRA, under the statute, can't enforce its rules against funding portals unless they're written specifically for funding portals, and meaning there's no registration mechanism yet because FINRA has never had to write rules for funding portals. So at the same time we're doing our rulemaking, FINRA is working, and Bob Colby can tell you on the second panel about what they've been doing, but they've been working very hard about getting their rules set together for funding portals. And the two need to work a little bit in tandem. The timing is a little awkward because they need to see what the SEC is going to do to inform their set of rules, but we're working very closely together to try to keep everybody informed. They've also put out a form for potential funding portals to voluntarily identify themselves to FINRA, so there can be a dialogue already before their membership rules are in place, and hopefully make the process for becoming a member a little bit simpler. Sorry, that was a long-winded answer.
How about this? On the second anniversary of the Jobs Act, do you think crowdfunding will be live?
Crowdfunding in what form? So are we talking?
Crowdfunding's live now.
Title III. Will Title III be up and running?
Look, for any of those, Mercer can hopefully tell you that he's worked at the SEC. It just is not possible for me to say on a date that it will or will not be up and running. I will tell you, personally, I and my staff, some of whom are here today, we're all committed to making it get up and running as soon as we can. So that's as far as I have in my control to say, and I don't think anybody who gives you a prediction on timing really knows what they're talking about it unless they've been through the process before and knows the factors that go into making an SEC rule final.
Okay.
Sorry, I know that's
Fair
not
enough.
a great answer, but that's where we are.
To your point, you have been working very hard, and we appreciate that as an industry. So, last question.
Hi, my name is Greg Simon. I'm CEO of Polywog, which is an introducing broker-dealer that's going to be doing crowdfunding and accredited investor crowdfunding for private equity and health companies, community businesses, and high-yielding assets like clean energy projects. There are a lot of different kinds of fraud you didn't mention today. The biggest crowdfunding endeavor in the country is Medicare. Everybody pays into it. There's $65 billion a year of fraud in Medicare. We do not stop the program. We do not stop doctors from offering services. We do not stop requiring people to be part of it. There's another kind of fraud, and that's when the Congress and the President pass and sign a law, and thousands of companies organize according to the principles in that law. And non-elected people, and I'm not talking about the SEC, But academics and people in consumer groups who disagree with the law make it their mission to prevent the law going into effect. That is a kind of fraud. And every day I'm reading stories of legitimate businesses that are going to go out of business because of the delay in implementing a law, not a theory, not a philosophy. I want to know what you think people are going to invest in if you keep them from investing in their neighbors' businesses. There is an assumption that they're going to do something rational that they otherwise would not do if they were given the opportunity to invest in a neighbor's business. Would that other rational thing be invest in a government-sponsored lottery? A government-sponsored casino?
Do you have a question?
Yes.
Back to the audience. Do you have a question?
I have a question of how you can sleep at night if you think that because somebody's not wealthy, they can buy an ETF on a market in Nigeria, and that's allowed, but you will not allow them to invest in a neighbor's business because you think we're going to grow the American economy by eliminating fraud. That is not how you're going to get there.
All right,
Question.
I appreciate
Do you think investing in the future is done because people take risk or that they flee from risk?
You have to be thankful for the most efficient, fullest securities markets in the world. And they are based on precisely the principles that you're attacking. So my answer is, if you want a market like we have in a lot of other undeveloped countries, then we'll follow your lead. But if you want a full, competitive market that grows capital and jobs, you want one with investor protection.
You cannot call mutual funds.
You
cannot call mutual fund fees a free and efficient market. You cannot call J.P. Morgan doing what they do and the average investor not being able to invest in a neighbor's business a free and efficient market.
Okay, well, thank you very much for your thoughts. I think they come from your heart, and we do appreciate that and understood. Clearly, I think being an entrepreneur and one of the people that wrote the framework for this legislation, I would like to see it implemented. But I respect the fact that we have laws and structure that we have to follow in this country. And to go back to the very beginning of this, we all want this to be an efficient marketplace. And in doing so, we need to make sure that we're following all the steps in order to do that. I don't like to delay as much as you don't like to delay. But I think if we can all agree that we need to get this done and give them the understanding that they're going to do what they need to do, then maybe we can get this up sooner than later.
Well, you and maybe David are the only two who agree it should be done on this panel. Thank you.
I wrote a crowdfunding exemption for the state of Kansas.
And I actually wrote a paper advocating for crowdfunding before it even came out, and also do advocate crowdfunding. Believe the SEC should have been left to do the rules and not guided by Congress, which I think added some bells and whistles I wouldn't have added. So not sure where that's coming from. But.
I'd just like to say, I'm sorry, we don't have time. If you'd like to come up and chat to the panelists over coffee, I'm sure we have lots more discussions, and it's great to end on such an interesting note. I really do appreciate that, because this is the purpose that we're putting this together. We're getting people who just don't necessarily agree. If you have people who agree all the time, then you don't actually develop the rules the way they need to be developed. So I'm sorry that we have to cut this a little short, but let's keep it going through the coffee break. We will have 15 minutes for coffee, and I would really like to thank all of the panelists and the questioners for a really interesting discussion. Thank you.